Stocks, also known as equities, represent ownership in a company. When you buy a stock, you become a shareholder, which means you own a small piece of that business. Companies issue stocks to raise capital, and investors buy them in hopes that the company will grow, increasing the stock's value over time. How it works. If the company performs well, its stock price may rise, allowing you to sell it at a profit. Some companies also pay dividends, which are a portion of their profits distributed to shareholders. Pros: high potential for growth, especially with well-established companies or emerging startups. Cons: stocks can be volatile, and their value can drop significantly if the company underperforms or the market declines. Bonds are essentially loans you give to governments, municipalities, or corporations. In return, the issuer promises to pay you interest over a fixed period and return the principal amount when the bond matures. How it works. Bonds are considered fixed income investments because they provide regular interest payments. Government bonds, like U.S. Treasuries, are generally safer, while corporate bonds offer higher returns but come with more risk. Pros: lower risk compared to stocks, predictable income stream. Cons: lower returns compared to stocks, and inflation can erode the value of fixed interest payments over time. Mutual funds. Mutual funds pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets. They are managed by professional fund managers who make investment decisions on behalf of the investors. How it works. When you invest in a mutual fund, you own units of the fund, and the value of your investment rises or falls based on the performance of the underlying assets. Pros: diversification, professional management, and accessibility for beginners. Cons: management fees, expense ratios can eat into returns, and some funds may underperform the market. ETFs, exchange-traded funds. ETFs are similar to mutual funds but trade like stocks on an exchange. They track a specific index, sector, commodity, or asset class, and offer a cost-effective way to diversify your portfolio. How it works. ETFs are bought and sold throughout the trading day at market prices. They often have lower fees than mutual funds and provide exposure to a wide range of assets. Pros: low fees, diversification, and flexibility to trade throughout the day. Cons: some ETFs may have lower liquidity, and trading frequently can lead to higher transaction costs. Real estate. Real estate involves buying property such as residential homes, commercial buildings, or land to generate rental income or sell it later at a higher price. How it works. You can invest directly by purchasing property or indirectly through real estate investment trusts, REITs, or crowdfunding platforms. Pros: tangible asset, potential for steady cash flow, and a hedge against inflation. Cons: requires significant capital, ongoing maintenance, and can be illiquid, hard to sell quickly. Commodities. Commodities are physical goods like gold, silver, oil, natural gas, or agricultural products. Investors often use them to hedge against inflation or market volatility. How it works. You can invest in commodities directly by purchasing the physical asset or indirectly through futures contracts, ETFs, or stocks of companies in the commodity sector. Pros: diversification, protection against inflation, and potential for high returns during market disruptions. Cons: highly volatile, influenced by supply and demand factors, and storage costs for physical commodities. Cryptocurrencies. Cryptocurrencies are digital assets that use blockchain technology to operate independently of central banks. Bitcoin, Ethereum, and Dogecoin are some of the most popular examples. How it works. Cryptocurrencies are traded on online platforms and stored in digital wallets. Their value is highly speculative and driven by market demand. Pros: high potential for returns, decentralized nature, and growing adoption. Cons: extremely volatile, regulatory uncertainty, and security risks like hacking. Index funds. Index funds are a type of mutual fund or ETF that tracks a specific market index, such as the S&P 500 or NASDAQ. They aim to replicate the performance of the index they follow. How it works. Index funds passively track an index, meaning they don't rely on active management. This results in lower fees compared to actively managed funds. Pros: low fees, broad market exposure, and consistent performance over the long term. Cons: limited potential for outperforming the market, as they simply track an index. REITs, real estate investment trusts. REITs allow you to invest in real estate without owning physical property. They own and manage income-generating properties like office buildings, malls, and apartments. How it works. REITs are required to distribute at least 90% of their taxable income to shareholders as dividends, making them an attractive option for income-focused investors. Pros: steady income, diversification, and liquidity compared to direct real estate investments. Cons: sensitive to interest rate changes and market fluctuations. Options. Options are financial contracts that give you the right but not the obligation to buy or sell an asset at a specific price before a certain date. How it works. Options are often used for hedging or speculation. For example, you can buy a call option to profit from a stock's rise or a put option to profit from its decline. Pros: flexibility, leverage, and potential for high returns. Cons: complex, high risk, and can lead to significant losses if not used properly. Forex, foreign exchange. Forex trading involves buying and selling currencies to profit from exchange rate fluctuations. It's the largest financial market in the world. How it works. Currencies are traded in pairs, e.g. USD/EUR, and traders speculate on whether one currency will rise or fall relative to another. Pros: high liquidity, 24-hour market, and potential for significant profits. Cons: highly volatile, requires deep market knowledge, and carries substantial risk. Peer-to-peer lending. Peer-to-peer (P2P) lending platforms connect borrowers with individual lenders, bypassing traditional banks. How it works. You lend money to individuals or small businesses and earn interest on the loans. Platforms like Lending Club and Prosper facilitate these transactions. Pros: higher returns than traditional savings accounts, diversification across multiple loans. Cons: risk of borrower default, illiquid until the loan is repaid. Hedge funds. Hedge funds are private investment funds that use advanced strategies like leverage, derivatives, and short selling to generate high returns. How it works. Hedge funds are typically available only to accredited investors due to their high risk and fees. They aim to outperform the market regardless of economic conditions. Pros: potential for high returns, diversification, and access to sophisticated strategies. Cons: high fees, lack of transparency, and limited liquidity. Annuities. Annuities are insurance products that provide regular payments in exchange for an initial lump sum. They are often used for retirement planning. How it works. You pay a premium to an insurance company, and in return they provide guaranteed income for a specific period or for life. Pros: predictable income, tax-deferred growth, and protection against outliving your savings. Cons: high fees, limited liquidity, and complexity. Collectibles. Collectibles include items like art, wine, rare coins, stamps, and vintage cars. Their value depends on rarity, demand, and market trends. How it works. You buy collectibles with the hope that their value will appreciate over time. They are often illiquid and require specialized knowledge to evaluate. Pros: potential for high returns, tangible assets, and personal enjoyment. Cons: illiquid, subjective valuation, and susceptible to market trends.